Ninja CPA Review presents the Assassin audio series for business, environment, and concepts. Narrated by Jeff Elliott, CPA. Copyright 2012. Ninja CPA Review, LLC. Chapter 1. Economics. We begin with supply and the supply curve. When the price of an item increases, supply for that item also increases. Why? Because more sellers are willing to sell more expensive items. Now, if supply changes due to something other than an increase or decrease in price, however, a supply curve shift occurs. A positive supply curve shift is a shift right. This is where supply increases at each price point, resulting in a higher equilibrium GDP. In this case, the number of sellers increase. For example, when MP3 players first came out, they were very expensive. People said, wow, 1,000 songs on this little device. So, more companies started selling MP3 players. The result was that the market became flooded. Some things that can cause a positive supply curve shift include government market interference. Think about when the government subsidizes a product or program or offers grants or tax credits to incentivize people to act and to buy things like green energy for wind farms, to buy corn for ethanol. All of that has an effect and it causes a supply curve shift. Technology improvements can also contribute to a supply curve shift. For instance, fast internet makes e-commerce efficient, so there are more people out there selling things on eBay. A negative supply curve shift is a shift left. This is where supply decreases at each price point, resulting in a lower equilibrium GDP. With a negative shift, the cost of producing an item increases. For instance, when the price of gold increases, less gold watches are made because they're more expensive to manufacture. An example of something that would contribute to a negative supply shift would be a war or some sort of crisis. If a country that grows rice gets attacked, then there is less rice on the market. So companies that use rice in production to produce their goods, they will see an increase in the cost of making their product. Next up is demand, the demand curve. When the price of an item increases, demand for it decreases. Think of gasoline. When the price is $5 a gallon, people are less likely to take their Suburban on a road trip. Now, if demand changes due to something other than price, a demand curve shift occurs. A positive demand curve shift is also a shift right. This is where demand increases at each price point, and again, it's due to something other than a change in price. A positive demand curve shift could result from the price of a substitute going up. For instance, if the price of beef rises, then there is more demand for chicken, a substitute to beef. Or maybe a future price increase is expected. If war in the Middle East breaks out, people start lining up at gas stations. Or the market could expand. For instance, if people get a new free healthcare plan from the government, then demand for those services at health clinics is going to rise. A positive demand curve shift results in expansion because more spending increases equilibrium GDP. Conversely, a negative demand curve shift is a shift to the left. This is where demand decreases at each price point, and this can result from the price of a complement going up. If the price of ketchup rises, then there is less demand for hamburger. Or if there's a boycott. Suppose a company commits some social blunder and every mom in America boycotts the store. A negative demand curve shift can also be caused by consumer income rising because demand for inferior goods drops as people have more money to spend. An example would be that college students stop buying cheap food once they get a job. We were all students at one point, and you know the cheap boxes of noodle packs I'm talking about. Or maybe consumer tastes change. That would also cause a negative demand curve shift. For instance, one hot diet fad gets replaced by a new diet. A negative demand shift results in contraction because less spending decreases equilibrium GDP. The marginal propensity to consume. Your marginal propensity to consume is how much you spend when your income increases $1. And you calculate it by, you take your change in spending divided by your change in income. Similarly, your marginal propensity to save is how much you save when income increases $1. Change in savings divided by your change in income. Again, marginal propensity to consume, change in spending divided by change in income. Marginal propensity to save, change in savings divided by change in income. The marginal propensity to consume and the marginal propensity to save must add up to 100%. The multiplier effect. The demand curve increases, in other words, shifts right, as spending by consumers and government increase. The multiplier effect says that the increase in demand ends up being larger than the amount of income spent in the economy. And the reason for this is because, say, a consumer spends money. Well, that money increases the income of the business that they visit, which in turn increases the income of the vendors that serve that business, which increases the income of the business and the vendors' employees, which increases income tax revenue. The irony that the more money a consumer has in their hands to spend, instead of sending it to the government, the more revenue that flows into the government. Price elasticity of demand. This is a very important topic for economics. Price elasticity of demand is calculated by taking the percentage change in demand divided by the percentage change in price. And I highly recommend that you work several price elasticity of demand problems because it's very likely that you will see these types of questions on exam day. You need to know how to calculate it. Elastic demand. A good is elastic if revenue drops when you increase the price. In other words, it's elastic, like a rubber band. Stretch the price one way and revenue will go the opposite. Decrease the price and revenue increases. Elastic goods have many substitutes, and an example would be luxury items. Increase the price and people will go buy something else because it's not something that they need. A good is considered elastic if the elasticity is greater than 1. A 10% change in demand divided by an 8% change in price is 1.25. It's greater than 1, so it's elastic. Inelastic demand. A good is inelastic if an increase in price leads to an increase in total revenue. You can raise the price, but people will still buy it. These include things like groceries and gasoline. If the price goes up, total revenue goes up. If the price goes down, total revenue goes down. Sticking with the rubber band analogy, elastic goods have price and revenue moving opposite directions, like a rubber band expanding. Since price and revenue are moving in the same direction, the rubber band is inelastic. Goods are considered inelastic if their price elasticity is less than 1. For instance, a 5% drop in demand results from a 10% increase in price. So 5% divided by 10%, again, 5% drop in demand, divided by a 10% increase in price, is 0.5. So you can raise the price 10% and you only lose 5% of your customers. Your total revenue still increases. 5% drop in demand divided by 10% increase in price is 0.5. What if the price elasticity is 1? Well, that means that there is unitary demand. Total revenue will remain the same if the price is increased. Income elasticity of demand. Income elasticity of demand is similar to price elasticity of demand, except change in income is the denominator instead of price. Percentage change of demand divided by percentage change of income. Normal goods have an income elasticity of demand greater than 1. In other words, demand for the good increases more than income. Inferior goods are less than 1. Demand increases less than income because as people's income rises, they want less of it. Inflation. Inflation occurs when interest rates increase, which reduces demand for loans, which also reduces demand for houses and cars. When my father was buying his first house, interest rates were around 17%. When interest rates are high like that, demand for houses and new cars are low because the financing is so ridiculously expensive. Inflation also causes the value of bonds and fixed income securities to decrease. As inflation rises, the purchasing power of these fixed income securities decreases. $1 of income from these securities used to buy 1 loaf of bread. Now bread is $1.10, and the purchase power of the security isn't what it used to be. Inflation causes the demand for inferior goods to increase. Again, going back to the boxed noodles from college, I literally tried one again a few months ago because those things will last forever. They're like a brick. When we leave college and actually make money, we don't want to eat those things anymore because we don't have to. They are inferior goods. Well, what happens when inflation causes the price of normal goods to increase? When that happens, inferior goods look more attractive. You won't see me with a 30-pack of those noodles on the bottom of my grocery cart anytime soon, though. Inflation also causes foreign goods to be more affordable than domestic goods, and the demand for domestic goods to decrease. Let me say that again. Inflation causes foreign goods to be more affordable than domestic goods, and the demand for domestic goods decreases. Demand pull inflation. With demand pull inflation, overall spending increases, and thus demand increases and shifts right. With demand pull inflation, the market equilibrium price increases. With cost push inflation, overall production costs increase, causing supply to decrease and shift left. Also, market equilibrium prices increase. Note that demand pull and cost push inflation both result in the market equilibrium price to increase. I wonder if that is a prime exam question. Again, note that demand pull and cost push inflation both result in the market equilibrium price to increase. We will now discuss equilibrium price and optimal production. The equilibrium price is where quantity supplied equals quantity demanded. Optimal production is the point at which marginal revenue equals marginal cost. Marginal revenue is the amount of additional revenue that is produced by increasing sales by 1 unit. Marginal cost, by contrast, is the increase in total cost by producing one more unit. When these two numbers are equal, marginal revenue and marginal cost, then you have optimal production. Economic measurements. Gross domestic product, GDP. GDP is the annual value of all goods and services produced domestically in the U.S. at current prices by consumers, businesses, the government, and foreign companies with domestic interests. That's key. Foreign companies with domestic interests. So included in GDP are U.S. factories owned by a foreign company. If you have a European beer company with a brewery here in the States, include it in GDP. Not included are factories abroad that are owned by a U.S. company. So if a U.S. beer company owns a brewery in Europe, don't include that brewery in GDP. And again, only the actual production from that facility, not the entire company itself. There are two approaches to calculating GDP, the income approach and the expenditure approach. The income approach includes sole proprietor and corporate income, passive income, taxes, employee salaries, foreign income adjustments, and depreciation. Again, real quick, the income approach includes sole proprietor and corporate income, passive income, taxes, employee salaries, foreign income adjustments, and depreciation. The expenditure approach only has a few variables. It includes individual consumption, private investment, government purchases, and net exports. Again, the expenditure approach, individual consumption, private investment, government purchases, and net exports. Nominal GDP measures goods and services in current prices. The GDP deflator is used to convert GDP to real GDP. Well, what is real GDP? Real GDP is nominal GDP divided by the GDP deflator times 100. Again, nominal GDP is goods or services at current prices. So when you see nominal, you can think normal. Nominal GDP is goods or services at normal or current prices. Gross national product, GNP. Gross national product is like GDP, but foreign production is flip-flopped. U.S. firms overseas are included, with foreign firms operating domestically not included. If you know GDP, then you can flip the foreign aspect and you know what to include in GNP. Consumer Price Index, CPI. CPI is the price of goods relative to an earlier period of time, which is the benchmark. Year 1 equals 1.0. Income and economic cycles. Disposable income. Disposable income is personal income minus personal income taxes. Basically, disposable income is how much money you have to spend after the government takes some of it. Return to scale. Return to scale is the percentage increase in output divided by the percentage increase in input. It's how much output you produce relative to inputs. So if that number is greater than 1, then there are increasing returns to scale, which is a good thing. If the percentage increase in output divided by the percentage increase in input is less than 1, then that means that there are decreasing returns to scale, which says that you are getting less than 1 output for every 1 input. A recession, and we hear this term tossed around by talking heads all the time, is when GDP growth is negative for 2 consecutive quarters. Again, a recession is when GDP growth is negative for 2 consecutive quarters. A depression is a prolonged, severe recession with high unemployment rates. There is no requisite period of time for the economy to officially be in a depression. Let's cover the economic cycle. It's like a wave that starts high, dips, bottoms out, and then goes back up. You start with the peak, and then it goes down to a recession. Then it bottoms out at the trough, then heads back up to recovery, and then expansion, and then it peaks again. And that's the cycle. Peak, recession, trough, recovery, expansion. Leading indicators occur before a recession or before a recovery. For example, the stock market or new housing numbers either drop or increase, signaling a recession or recovery is coming. Lagging indicators, however, occur after a recession or after a recovery. They include prime interest rates and unemployment figures. Coincident indicators occur during a recession or during a recovery. An example would be manufacturing numbers. Unemployment. To calculate, you only include people looking for jobs. Cyclical unemployment. This is where GDP doesn't grow fast enough to employ all people who are actually looking for work. People are unemployed because there aren't enough jobs available due to the economy, and that's cyclical unemployment. Frictional unemployment is where people are changing jobs or entering the workforce. This is a normal aspect of full unemployment. An example would be recent college graduates looking for a job. That's frictional unemployment. Structural unemployment is where a worker's job skills do not match those necessary to get a job, so they need to get more education or training. A construction worker who wants to work in an office, well, they quit their job and go get computer training. That's structural unemployment. Interest rates. The discount rate is the rate a bank pays to borrow from the Federal Reserve. The prime rate is the rate a bank charges their very best customers on short-term borrowings. The real interest rate is an inflation-adjusted interest rate. The nominal rate is the rate that uses current prices. Remember nominal GDP? Nominal GDP measures goods or services in current prices. Similarly, the nominal rate uses current prices. When you see nominal, think normal or current. The risk-free rate is the rate for a loan with 100% certainty of payback, which usually results in a lower rate. U.S. Treasuries are an example. Money supply. M1 includes currency, coins, and deposits. M2 is highly liquid assets. Government and the economy. Deficit spending results from increased spending levels without increased tax revenue to support it. It also occurs when taxes are lowered without a decrease in spending. The government may do this as a gamble that the multiplier effect will take over and boost the economy. That's deficit spending. Government securities. The money supply can be controlled by the Fed's buying and selling of government securities. The discount rate. The Fed can control economy-wide interest rates by adjusting the discount rate charged to banks. International trade restrictions. A tariff is a tax on imported goods. A quota is a limit on the number of imported goods that are allowed in the U.S. Trade restrictions are good for domestic producers because the demand curve for their goods shifts right because there are fewer substitutes, which allows them to charge higher prices. Trade restrictions are bad for foreign producers, and the demand curve for their goods shifts left because there are fewer buyers, which forces them to charge lower prices. Trade restrictions are good for foreign consumers, and their supply curve shifts right, and their goods are purchased at lower prices. Trade restrictions are bad for domestic consumers, and their supply curve shifts left because fewer goods are bought due to higher prices. So let's recap again. Trade restrictions are good for domestic producers, bad for foreign producers. Trade restrictions are good for foreign consumers and bad for domestic consumers. The final topic in this chapter is accounting and economic costs and profits. The accounting cost is the explicit, in other words, actual cost of operating a business. Implicit costs are opportunity costs. Accounting profit is revenue minus accounting cost, which again is the actual cost of operating a business. So accounting profit is revenue minus accounting cost. Economic cost is the explicit plus the implicit cost. The actual cost plus the opportunity cost is the economic cost. Economic profit is revenue minus economic cost. So revenue minus a combination of actual and opportunity costs. This concludes Chapter 1.